Now, a longer-term look at the euro with the man who laid the groundwork for its creation. Robert Mundell is a Nobel Prize-winning economist and professor at Columbia University, and we're grateful to have a couple minutes with you. Robert, thanks so much for joining us. Let me ask you first about your work on optimum currency areas. What do you mean when you say optimum currency area? What is that?
Well, that was designed to try to find the zone over which a currency would have an important economic effect. What was the optimum? Historically, currencies have been identified with political areas, but the question was to find out what's the economic function of currencies and what would be the optimum area over which they'd have jurisdiction. So
what do you think about Europe now? I mean, it's been rough the last couple of months, obviously. It worked, though, very well. I mean, a lot of people forget 120 is not a terribly low level for the euro. I mean, I remember when it first was introduced and I bought a car in Germany in dollars, it was 85 cents. So historically still pretty strong. Is Europe and the countries that now use the euro, is that, in your opinion, an optimum currency area?
Well, it depends. There's a technical definition, but the fact is that the practical definition of it now is both a political and an economic concept. And I think that it's pretty close to an optimum currency area. But the one issue that was that turned out to be the weakness right now was the fiscal discipline. And the problem was that the creation of the euro, to a certain extent, might have even undermined some fiscal discipline because it took away that threat of devaluation. And that's what created a kind of free rider problem, let countries have more of more spending than they would have done had they had their own currency.
Now, Professor, Matt Carroll, a lot of us in the newsroom, we talk all the time about, these people who talk about, it losing its reserve status, so to speak. Is there a reserve currency besides the dollar? A lot of people saying it was the euro, and now that's being called into question with a lot of people, perhaps China, a lot of other, Iran even maybe saying that they want to sell their euros to buy dollars, perhaps. So is the euro as prestigious as it used to be?
Well, I think the lower it gets, the better buy it is, because the more upside potential it is. There's a lot of people who think that after the political arrangement gets worked out with the fiscal situation, the euro will go up high again. Remember, it was just 2 years ago in June, 2 years ago this June, it was $1.64. So now it's come way down. But when the euro came into being, it was $1.18. So it's now still around that level. It's not in low territory. It was only the first 2 years of it. It went into the tank. It went down to 82 cents. There's a lot of speculation against it. But I don't think it's ever going to go down in that direction again because there's enough strength. The European economies are going to be more strong now because of the more competitive exchange rate. So I think that's going to be bullish. I think also the lower euro is going to improve their fiscal situation, as it always does. Just as on the other side of it, the high dollar is having some negative effects on the U.S. recovery. It's a big threat that this strong dollar now, like that 2 years ago in the summer of 2008, that the dollar shot up by 30%, and that was a big factor in creating that going in the tank of not just Bloomberg, but also Fannie Mae and Freddie Mac.
We're looking at a dollar chart now, and you can see here the rise year to date. Is this a concern for you for the U.S. economy? I mean, we're starting to get more and more mixed economic data. It's looking like there's a soft patch, as some economists have come on the show and said. Is this one of the main reasons?
Well, I think it is. I think it's exactly what happened 2 years ago. It's like we're heading into a summer, like the summer of 2008, where the situation is somewhat very similar because you're getting into, there was a 30% increase in that summer in the euro, and that's just over the period when the big financial crisis came. And now this strong dollar now is going to slow down the recovery. You see retail sales, you see a lot of things, negative signs now, as if it's going to choke off the recovery. So I think the strong dollar is a symptom of the fact that there's a shortage of dollars out there, because the dollar is now an international currency, and the Europeans need dollars as well as Americans. And if they have an increase in demand for dollars and the dollar goes up, that strengthens and tightens the market in the United States as well, and it hurts the recovery in the United States.
Well, you mentioned unfortunate point about supply of dollars shrinking. Doesn't that just eventually lead to higher interest rates? The less dollars there are out there.
Well, it doesn't though. You see, what you have two. There are two exit policies. One exit policy is with when Bernanke and company raise the interest rate. The other exit policy is when the dollar appreciates. Now, in the summer of 2008, when all the financial crisis hit the fan, you had the dollar appreciating, but the Fed didn't seem to regard that as a crisis situation and let it go on. And I'm afraid they're going to do the same thing now.
Well, and Ben Bernanke typically says it's not really his revere to try and move the dollar. The Fed doesn't want to intervene in the currency trade. You think that should be
that's completely wrong-headed, because now what happened is that before the euro was created, the dollar represented the mainstream of the world economy, and all currencies were related to that. But with the creation of the euro, you have not just the non-dollar out there, but the non-dollar is really the euro area, and the euro area represents a strong currency of its own, and you've split the core of the mainstream core of the world economy. So you get this big tug of war is split this. It creates confusion in financial markets and everything. I think that the Fed for really 30 or 40 years has made big mistakes by ignoring the exchange rate. Look what happened when in the late 1970s, when they let the inflation rate get up to 13%, the dollar went into the tank, the price of gold went up to $850 then at that time. And then it turned around, clamped down again, tightened, and then the dollar soared. It doubled against the Deutschmark and put us into that 1982 recession. So big problems when the Fed starts to think that it can afford to ignore these big swings in the exchange rate.
All right. Hey, Bob, thank you so much for spending some time today with us. We really appreciate it. Robert Mundell from Columbia University, Nobel Prize winner.